Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Monday, April 7th, 5:30 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Roundup Daily Market Insight video. Market state, we're in a harsh correction. We define that as being 12%, 12 to 20% off of the recent highs in the S&P 500. We briefly hit bear market territory during today's session, but bounced off of that level. We're about 17.7%, actually 17.61% off of the high in the S&P 500. Check the trend gauge over here. We've got the hated, loathed, despised, detested four red arrows, leadership non-existent, and the major averages all trending below their short-term 21-day moving average, medium-term 50-day moving average, and long-term 200-day moving average. So what happened today? Futures last night, Sunday night, gapped down at the open and sold off hard, but they did put in the low of the overnight session within 5 minutes of the open. So when you're looking to put check marks in plus and minus categories, that was a plus, and it's a level that you can reference throughout the rest of the evening and the trading day. At the open, things got a little bit better periodically, but by the open, we gapped down 3.2% on the S&P 500. But then again, within the first 15 minutes, we tested that overnight low and it held. We had a bounce on a false headline. The market then pulled back and consolidated, not really in a tight range, but a choppy range as there's a lot of volatility going on, needless to say. But by the end of the day, there was some news coming out. Treasury Secretary Bessent said he'll be negotiating directly with Japan, who said they want to reduce tariffs. Bibi Netanyahu from Israel was in the Oval Office today. He said he wants to drop tariffs to the U.S. to zero. Bessent also said that 70 plus countries have reached out. Ursula von der Leyen from the EU said they want to get serious about reducing tariffs. So there was some positive news on the tariff front, and the bottom line is that that third gap down did find support, and by the end of the day, we closed above half in the range, which on the S&P 500 makes it pink rally day one. Nothing to get too excited about, but what we do is watch the lows of today, very critical, and for a little bit of a tighter time frame, watch the lows of the intraday range that was set up after the initial volatility in the morning. NASDAQ 100 actually finished positive, so that had a true rally day one. Here are the numbers on the day. 2121 list under construction. Leaders don't exist right now. We'll let the market decide them out. There are some great fundamental names that we have our eyes on to see if they can firm up, form bases, or at least give low risk, reasonable entry points. The big eight down an average of 0.5%. The RG8, our 8 growth ETF composite, down 0.25%. S&P by the end of the day just down about 0.25%. Equal weight S&P down 0.8. NASDAQ 100, the leader, positive by 0.25. Equal weight just barely positive. We'll look at the Dow, mid caps, and small caps, which all performed worse when we look at the charts. Global 60/40 stock and bond down 0.95%. Our flagship GROTECTION portfolio just barely negative, down 0.04%. Let's get into the charts, and we'll start off with the S&P 500. Let me get rid of stochastics to make this look a little bit better, but obviously this is a crazy 3-day chart here. Over the weekend, we had a lot of team discussions, and we were looking for, in fact, when Ted did the video Friday, he said one of the things we're looking for is a possible third day gap down mean reversion trade. And we took advantage of that in our portfolios today. With that gap down, and the weakness, I was covering some of the hedges that I have. And TurboTection took a starter position, actually a pretty decent size, 20% position in SPLG, got a good entry. And we can trade against today's lows, or if you look at a 5 minute chart, you can see this tight range 49.51 to 51.21. That was 5.5 hours today. We traded within that range after the initial gap down and then the fake news spike higher. So, a couple of reference points, the highs and lows from today, the highs and lows of the intraday range. But when things are under the 200-day moving average, we normally are completely hands off, but we do have some shorter term rules that we use in house. And one of them is certainly reversion to the mean with three gaps down. And that was what we took advantage of today. That's what you take what the market gives you. And if we think we can squeeze out a little alpha for our clients, we're going to do it as long as the risk is low. What we want to also watch for next is the declining 5 day simple, 8 day exponential moving averages. Those are the first two short term averages that the indexes will run into if they continue to go higher. A bunch of names rejected at the declining 8 EMA today after that false headline came out. But now we're looking to separate the wheat from the chaff and the isolating relative strength. And that first sign of relative strength will be how things act, including the indexes, when they run into declining short-term moving averages as quick as possible. You want to turn those short-term moving averages back to the upside and get price above it is the only way to do that. So there's the S&P 500, NASDAQ 100, slightly positive on the day. Again, you see the big range. And again, reference points are the intraday range and the high and the low of today after that third gap down. Let's go to the Dow Jones Industrial Average. It was down 0.91% today, third close lower, but you can see also finished quite a bit off the lows. Let's go back to the equal weight S&P 500 very quickly, down 0.83, lower low, closed about mid-range. Mid cap 400 back inside the range after the gap down 1.11%, and the Russell 2000 same situation, gap down, closed inside the range from Friday. Watch the high and the low of these days. Let's see what's next. On to interasset correlation. We'll start with the dollar. And dollar broke this range this multi-week range that it had been trading in, and went lower, which is on the fears and the tariff and everything that's going over. But it did spike the last 2 days and is back near the bottom of this range. The VIX has had two closes above 45. This is extremely rare. The VIX was up another 3.7% today. That's extremely rare. That was another reason why when you're stretched like this, positive headlines coming out, finding support overnight and intraday, another reason why we were okay taking a short, a small starter in the S&P 500. Next, we will look at precious metals. Gold, we stopped on this today with a break of the 21-day moving average. Gold and bonds had been holding up, but you can see 3 days down for gold now. That's somewhat of a change in character, although it's still above the ascending 50-day moving average. Silver was positive on the day, but that really fell apart the prior 2 days. Gold stocks were up early, faded, ended up lower on the day. Bitcoin, which showed a lot of relative strength on Friday, certainly didn't today, down 7%, sitting right on its 200-day moving average. On to bonds now, and this is a little bit of a negative. It's looking like bond prices gave a false breakout to the upside, as in one day we came all the way back to the bottom of this range that we broke out. So, if prices are down, that means yields are up, and that is not what the administration is looking for. Here's TLT, very similar setup, failed breakout there, back close to the bottom of the range there. And that means the yields, which had been dumping, is a failed breakdown there as well, back into that multi-week range, both on the 30-year and the 10-year. You can see again, failed breakdown back into the range. So that's not good for administration that wants lower interest rates to refinance $7 trillion in debt by June and 9 trillion by the end of the year. So that's our inter-asset correlation. Let's go to the tail of the tape. And that is right here. Uh, I mentioned the VIX. Fear and greed is at a 4, extremely low. We're below 50 on NAAIM, and with the AAII bulls being at above 60. That's a 52-week high, and it's also been above 50 for 4 weeks now, which is normally contrarian bullish, but we're not getting it at all with the tariffs obviously throwing a monkey wrench into everything. But news, as I mentioned, 70 plus countries have supposedly notified the administration that they want to start negotiations. One that isn't is China. They are sticking with their tariffs. Trump threatened additional tariffs on them again today if they don't retract the 34% that they put on, but they said uh, they will do internal stimulus to their country, and they're also capable of um, manipulating their currency. They set the currency pegged to the dollar, so they're able to blunt the negative impacts of tariffs by using those two tools, which obviously is not what Trump wants to hear. He's coming into today, as I mentioned. Day three gap down mean reversion. Yep, we got that, and the pink rally day on the S&P, legitimate rally day one on the Nasdaq 100. Day count down 2 to down 3, but with the pink rally day one, 3 days below the 8-day exponential moving average, 9 below the 21-day moving average. Our expectations remain negative as long as we're below that 21-day moving average. From a sector standpoint, standouts today, mostly tech, semiconductors, XLC's communication services, XLK, obviously tech. To the downside, ITB with the drop in rates, that's builders, crude, and then 5 value sectors. Growth actually outperformed value today. Basic materials, XLY, not a value sector, but that was weak as well. XLPU and RE, that staples, utilities, and real estate, had a rough day. In the portfolio, stopped on TLT with that reversal and stopped on GLD, reduced our SPLG hedge. So adjusted balance 0.09%, which basically means 9% long the S&P 500, and balance at risk 0.39% to the downside. Bottom line on the day, third day gap down, found support, and it resulted by the end of the day in a pink rally attempt day one for the S&P 500. Keys going into tomorrow is the highs and lows of Monday's range on the S&P and the Nasdaq. I also wanted to quickly read so many stories in on Twitter over the weekend about people just devastated about their portfolios. Either they didn't sell or their advisor didn't. But let's quantify a little bit the difference between following the Revere system, GROTECTION, grow assets in an uptrend, uh, protect them in a downtrend. So the market topped on 219.25, the S&P 500 at 61.44. Let's just say, hypothetically, that same day, if somebody was completely invested in the S&P 500, they hit $1 million. And if you were in GROTECTION 100%, you hit $1 million, just hypothetically. Over the next 7 weeks, the S&P 500 has dropped to 50.62. That's a 17.61% drop. Our goal with GROTECTION is to remain within 10% of our high watermark. And that's where we are right now. We're 9.25% off the high. So if you hit 1 million on the market high, you still got 907,500. Nobody likes losing nearly $100,000. But compare that to that S&P 500 allocation down 17.61%. You're all the way down at 823,914. The good news is we're compounding when we re-entered the market from a much higher asset base than if you rode this all the way down. And remember, this was lower intraday too, as it was under 800,000. as we were 21% down off the high at the lows of the day today and overnight last night. So we usually like to talk in percentages, but percentages is not what you spend. It's not what it shows in your 401k. It shows a dollar amount. And this is the equivalent dollar amount to staying all in with the S&P 500 or following stops. And we always say risk is at its highest when you're below the 200-day moving average. That one rule will keep you out of so much trouble. All right, let's look at a couple of tickers. Three that were high on the list coming into today and see how they responded. Rocket Mortgage had a good day on Friday, near the top of this range, in fact, as interest rates were dropping. However, they reversed today. Rocket down 4.81%. Still one of the better looking charts out there as far as where it is versus its highs over the last couple of weeks. Another one watching was Ali. Chinese tariffs. Ali sells a lot of stuff from China. They had been holding up a lot as they're acquiring a bunch of big lot stores for pennies on the dollar. One of the better failed breakout, but was still within the pivot minus 7% range, but not anymore, dropping 4.61%, breaking the 21-day moving average. Celsius, another one that has been holding up pretty well and still holding up very well. Bounced at the 21-day moving average, and it's near its highs over the past week, just down 0.23% on the day. And one more, Vertex, VRTX. They've got the N and Can Slim is their new non-opioid pain reliever. Suffered a big drop intraday, but the relative strength line is at a new high, and it undercut and reclaimed the 200-day moving average today. These are just an example of some things that we're watching. We're watching about 50 names altogether for potential. Add a few every day. ITB was something we liked after the action last week. Well, look what ITB did today with the reversal in interest rates, down 4.13%. So this declining 21-day moving average continues to cap any advance in the home builders. That's going to wrap it. As always, like to hear from you. The email's don@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. If you're interested in becoming a client, you can email me or my partner, Dan Stewart. That'd be dan@revereasset.com. And as a reminder, our flagship portfolio of protection is designed to grow assets during uptrends, which we've demonstrated very well how we do since November of 2023 when we had that very nice follow through day that led to a big rally. But we also know how to protect them during downtrends, especially if you break that 40-week or 200-day moving average. And that's where we are now. Give a little bit of leeway based on some recent research that we did, about 3 to 4% below the 200-day. But now the slope of the line has rolled over, and you can see what happened the last 3 days since we broke that 3+ week consolidation that we had within that 3 to 4% range. That's going to wrap it for Monday, April 7th. This is Don Vandenbord with Revere Asset Management, telling it like it is. It's not how much you make in the market, it's how much of that you can keep. Thanks for listening, and have a great day.